Hi, everybody. This is Mallory Flowers on behalf of Jennifer Schaus and Associates, and we are coming to you live from Washington, D.C. And welcome to our Webinar Wednesday series. Our webinars are held every Wednesday in 2018 at 12 p.m. and 12:30 p.m. Eastern Time, and our speakers range from accountants to attorneys and other industry professionals. The full schedule for the rest of the year is on our website underneath the webinar tab. In the interest of time, we do not take questions, and our speakers' contact info is posted on the last slide. So if you have any questions, please contact the speaker directly. The recordings are on our website underneath the Archived Webinar tab, as well as on our YouTube channel. And this is just a quick blurb about us. Jennifer Schaus and Associates is based in downtown Washington, D.C., and we help both product and service companies with federal contracting. Our clients are domestic and foreign, defense contractors and civilian, and our services range from market analysis reports to contract vehicles, including the GSA schedule. We can also help you with proposal writing and post-award contract administration. More information about our services and upcoming events can be found on our website. This is one of our upcoming events coming up on November 27th. You can find more information about it on our website. All right, so we're going to go ahead and dig into today's presentation, which is Keeping Your Books Clear of Federal Unallowable Costs, and Marsha Lindquist is our speaker today. We're going to learn more about her background on this slide. Thank you, Marsha, for joining us, and I'm going to go ahead and hand over to you.
Thank you very, very much. Next slide, we're going to talk about keeping your books clear of federal unallowable costs. So probably people are wondering, what are unallowable costs? So the most important thing to know about unallowable costs is that sometimes they're identified in FAR Part 31.205. If you go onto on Google and type in FAR 31.205, you will see some of those costs, and there's great text about it. It'll put you to sleep if you really want to. And those things that are unallowable tend to be things like public relations and advertising, contingencies, contributions. Some employee morale costs are not allowable or unallowable. Entertainment costs are unallowable. Lobbying, interest and financial costs. Those are costs that the government has determined are unallowable, or some things that they will not pay for. The most famous one that everybody knows about are alcoholic beverages. So those are the types that are unallowable. The kinds of costs that are allowable are things like compensation, engineering and manufacturing, selling, depreciation, bid and proposal type costs, insurance type costs, materials. And here's one that people think often are not allowable, but they are termination costs. So, and I like to highlight that one last, because if you've gotten a termination for convenience, that's the time to raise your hand and say, help, I need to know how to make those allowable. So let's go on to our next slide. And we just talked about what costs are allowable. I'm getting ahead of myself very, very much this morning. And so go to the next slide. And here's a great link that I really want people to take note of. It's FAR Cost Principles Guide. It's a DCAA publication that tells you all about the FAR cost principles. While FAR 31.205 does address it, this particular guide is a little bit more helpful for people. So I like for people to know about this one and use it. So download this, read it, take a look at it, refer back to it frequently, and it will help you along with knowing what's allowable and not unallowable. Next slide. So what policies do you need to have in place to, shall I say, deal with unallowable costs? Policies that I like to say are kind of the minimum when we're talking about unallowable costs. And there are 5 of them. You obviously have to have a policy that talks to how you deal as a company with unallowable costs. Another policy that I like to say kind of goes hand in glove with that are detailed records of unallowable costs. In other words, a policy that states how you are going to deal with your records of unallowable costs, because you can't just toss those records out. You must keep them. Another one that I like to say is important is direct and indirect costs, which do delineate what is allowable as a direct and what is allowable as an indirect cost. It's the other side of unallowable. The other one that I like to have a policy on is unbillable costs, which are different from unallowable costs. They are contract costs that are that are specifically identifiable with your contracts or tasks, but for some reason or another are not billable. It's a separate kind of category, but they are not unbillable costs. Again, a policy on how you deal with unbillable costs is important. And then the last one that I like to have is one that's called consistency in cost accounting, because you've got to be consistent in the way you treat your costs, regardless of whether you are covered by CAS or not, and that includes unallowable costs. Next slide, please. So what do you need to do to separate unallowable costs? Well, most important is that you need to treat unallowable costs, identify them when they come into your books. That's the first stage of it. You need to identify what they are and actually charge them into unallowable accounts. So most companies do set up a bank of accounts that are strictly unallowable costs. You can have them segregated in your general ledger that way. You must eliminate all unallowable costs from any indirect pools or any direct charges. And you must include them, here's an important part, include the unallowable costs in the base for G&A, because they do attract G&A just like anything else. So, and you may have some unallowable costs that may be overhead costs, so they also need to be in the base for overhead. So the other stage that you need to take care of separating unallowable costs is when you do your internal control process once a month when you are reviewing your general ledger. That is the time also to make sure that you've charged those unallowable costs directly into those unallowable accounts when they were booked. But here's the place where you would catch any that maybe slid through. So when you're reviewing your general ledger, you get a second chance to take a look at what's in your accounting records and separate them out then. It's better to put them into unallowable accounts at the onset rather than moving them. When auditors see that you've moved unallowable accounts, while it's not unacceptable, it's better to identify them at the onset when you first book them into your general ledger. Next slide, please. So what do you want to do to treat unallowable costs? Okay, so again, I mentioned that you need to remove them from any indirect pools or any direct charges. You must include unallowable costs in the base from which you've removed them. If it's an overhead unallowable cost, it still needs to be in the base, the denominator for that overhead rate. You must also include unallowable costs in the base for G&A. So you need to distinguish between the two and make sure that they get their fair share of G&A. Okay, next slide. So how do you distinguish unallowable from unbillable? This is an age-old question, by the way. How you distinguish them. Unbillable costs are costs that are specific to a contract or task, but your client is unwilling or unable to, by contract, reimburse you for it. An example of that very well may be warranty costs. If you warrant your work that you're doing, but you've got to go back in and rework it, then that cost would be an unbillable cost, not an unallowable cost. They must be treated and recorded as unbillable in the case that I just described, as an unbillable contract cost, as opposed to an unallowable cost. I'm sorry. Unbillable costs get fully burdened just like billable costs do, and unbillable costs are not indirect costs. You can't take that warranty work example that I just gave you and put those costs, into your overhead. You must put them as a contract cost that is not billable. So, lastly, what is an unbillable cost? It's really a contract cost that's not covered by your contract. It is, ultimately, you have to ask yourself who receives the benefit. If your customer receives the benefit and you did it under that contract, then it would be determined to be an unbillable cost rather than an unallowable cost. Again, we talked earlier about what those examples are of unbillable. Next slide, I think we're going to do a quick wrap-up. I want to thank you for attending. I want to take any questions that you all may have out there. I don't see any in the chat box, but maybe you're getting some through on, from other people that I can't see.
We actually don't usually take questions. So if you do have any questions, please contact Marcia directly, either at her phone number or the email that you see on your screen.
And I'm happy to take those questions. A lot of people email me immediately after and say, geez, I forgot to ask this question, or I wanted to ask this question. So I'm open to those if people want to email me or call me.
Okay, perfect. Thank you so much, Marcia, for presenting today. And thank you for everyone who joined us. And like I said, contact her if you have any questions. Next week at 12, we are covering types of federal contracts. And at 12:30, we are covering key concepts in federal subcontracting. And that's it. Thank you, everybody.